On October 19th, 1987, the Dow Jones dropped 22.6% in a single day. No war had started, no bank had collapsed, no president had been assassinated. When investigators tried to figure out what triggered the largest one-day crash in stock market history, they found something deeply unsettling. Nothing triggered it. The crash had triggered itself. This wasn't supposed to be possible. Markets, we're told, are rational. They process information. They reflect reality. But that day, reality didn't change. The market just decided to eat itself. And here's the uncomfortable part. The conditions that made it possible haven't gone away. They've gotten worse. Let's rewind to understand what actually happened. And fair warning, once you see how this works, you'll start noticing the pattern everywhere. In the mid-1980s, Wall Street discovered something revolutionary. Computers could trade faster than humans. Not just faster, exponentially faster. A human trader might execute a dozen trades in a day. A computer could do thousands per second. This wasn't just an upgrade, it was a different species of trading entirely. One strategy became particularly popular. It was called portfolio insurance. The idea was elegant, almost beautiful. If stocks start falling, automatically sell them before the losses get worse. It's like a stop-loss order, but weaponized and running on autopilot. Institutional investors loved it. By 1987, portfolio insurance was protecting over $60 billion in assets. Here's the thing about elegant ideas. They work brilliantly until everyone uses them at once. October 19th started badly. Stocks opened down. Not catastrophically, just down. But that was enough. The portfolio insurance algorithms saw the dip and did exactly what they were programmed to do: sell. Those sales pushed prices down further, which triggered more algorithms, which triggered more selling, which triggered more algorithms. Within minutes, the market entered a death spiral. Humans weren't making these decisions anymore. Machines were reacting to other machines, reacting to other machines, at speeds no human could comprehend, let alone stop. Traders on the floor described it as watching a dam break in slow motion, except the slow motion was actually happening faster than their brains could process. By the closing bell, the market had lost $500 billion in value. That's roughly $1.3 trillion in today's money, evaporated in 7 hours. The absurd part, the economy was fine. Corporate earnings were fine. Nothing fundamental had changed. The market had essentially panicked at its own reflection. Now here's where it gets uncomfortable. After 1987, regulators added circuit breakers. If markets fall too fast, trading halts. Everyone takes a breath. In theory, this prevents cascades. In practice, it just changed the game. Because the machines got smarter, way smarter. Today, high-frequency trading firms account for roughly half of all U.S. equity trading volume. Half! These aren't portfolio insurance algorithms from the 80s. These are predatory systems designed to exploit microscopic inefficiencies, front-run orders, and extract pennies from millions of transactions per second. They operate in timescales measured in microseconds. The blink of your eye contains 300,000 microseconds. In that single blink, fortunes change hands thousands of times. And here's the mechanism you need to understand: liquidity. Markets work when there are buyers for every seller. When you hit sell, someone hits buy, and the system functions. High-frequency traders provide a lot of that liquidity. They're the buyers when you sell, the sellers when you buy. Except they're not doing it out of generosity, they're doing it for profit. And when things get volatile, when risk gets too high, they have one strategy: vanish. May 6, 2010, the flash crash. At 2:42 p.m., the market dropped 600 points in 5 minutes, not hours, minutes. Procter & Gamble shares fell from $60 to $39 and recovered within minutes. Accenture shares traded for 1 penny.
1 penny, a company worth $30 billion, was briefly valued at about $8,000 total. The trigger was traced to a single large sell order, nothing unusual, but when that order hit the market, high-frequency traders detected the pressure, pulled their bids, and within seconds there was no liquidity, no buyers, just a void. Prices fell not because anyone thought they should, because no one was willing to catch them. The market recovered, it always does, until it doesn't. But that phrase, until it doesn't, is doing heavy lifting. Because here's what regulators found. The machines hadn't malfunctioned. They'd worked exactly as designed. The crash was a feature, not a bug. So let's talk about now, right now. As of this recording, U.S. equity markets are valued at roughly $50 trillion. A staggering amount of that value is held in passive index funds. These funds don't pick stocks, they just buy everything in the index. When money flows in, they buy. When money flows out, they sell. No judgment, no analysis, just automatic allocation. This has created the most stable bull market in modern history. Money flows into index funds buy stocks. Stock prices rise, more money flows into index funds. It's a beautiful self-reinforcing loop until it reverses. Because the same mechanism that lifts all boats will sink them just as efficiently. When redemptions hit, when investors pull money out, index funds don't choose what to sell. They sell everything, proportionally, mechanically, and if everyone's selling at once, the high-frequency traders who normally provide liquidity will do what they did in 2010, disappear. Add in algorithmic risk parity strategies, volatility targeting funds, and leveraged ETFs, all programmed to sell when volatility spikes, and you have the same conditions that caused 1987, except faster, and much, much bigger. The uncomfortable math looks like this. In 1987, it took 7 hours to lose 22%. In 2010, it took 5 minutes to lose 6%. Speed is compounding, scale is compounding, and nobody really knows where the breaking point is because we've never tested it at this scale. There's a phrase in system dynamics, stable until it isn't. Markets feel stable right now. They've felt stable for years. That stability isn't a sign of strength, it's a sign of uniformity. Everyone's using similar algorithms, similar risk models, similar triggers, which means when one domino falls, they all fall. Not because of fear, not because of news, but because the system is designed to amplify, not absorb. Here's the irony. We've spent decades building faster systems to prevent crashes, and in doing so, we've created the perfect conditions for one. The circuit breakers, the regulations, the high-frequency liquidity, all of it assumes humans will remain in control, but humans stopped being in control somewhere around 2005. We just haven't admitted it yet. So when's the next crash? No idea. Could be tomorrow, could be 10 years from now. The question isn't when, the question is whether we'll even see it coming. In 1987, traders at least had 7 hours to panic. Next time, you might check your phone at lunch and find out it already happened. And the strangest part, the crash won't need a reason, it'll just need a spark. One algorithm misreading data, one flash of volatility, one cascading wave of automatic selling, and by the time anyone realizes what's happening, the machines will have already decided. Sleep tight.